Hello everyone, welcome to Lineup Stocks. I'm Will. Today is March 22nd. The US-Iran conflict is still escalating, and geopolitical uncertainty is bombing all kinds of asset prices. The three major US stock indexes have hit 200-day lows. The prices of oil and the US dollar are flying high, and the 10-year US Treasury yield has even reached a peak of 4.4. It is simply crazy. Let's take a look at what exactly happened, where geopolitics is heading, and where the US stock market is heading. A few days ago, the Pentagon deployed its forces, sending 8,000 Marines. They took F-35B fighter jets, hovercrafts, and landing crafts, marching massively into the Middle East. Their target is aimed directly at Karg Island, the lifeline of Iran's oil exports. Actually, as early as the 14th, the US military launched a large-scale precision strike on Karg Island. They destroyed more than 90 Iranian military targets, bunkers, and missile facilities on the island, but deliberately avoided the oil infrastructure. US President Trump confirmed in interviews and on social media that the US military has completely destroyed the island's military zone. He made it clear that keeping the island's oil facilities intact was out of restraint. However, he warned that if Iran continues to block the Strait of Hormuz or interfere with international shipping, the US military will reconsider this decision and is ready to destroy these crude oil facilities at any time. We don't know what kind of military results this US deployment will bring, or what kind of impact it will have on oil prices. Iran obviously does not plan to accept this plot silently. Although Karg Island is only a few miles long, as Iran's economic lifeline, it holds a very high strategic position. CBS and relevant national security analysts pointed out that for decades, Tehran has been heavily reinforcing the military defenses of Karg Island. Not only are dense air defense systems deployed on the island, but they have also built solid military infrastructure and underground oil storage. This is designed to ensure that even under continuous military strikes, the storage and flow of crude oil can be maintained. At the same time, they use drones to attack Kuwait's largest refinery. Meanwhile, the Houthi rebels also joined the party, stating that they could block the Bab el-Mandeb Strait, which is another key oil channel for the world. Today's oil market is more exciting than any Hollywood blockbuster. Goldman Sachs and Saudi oil officials are playing a game of who can be more pessimistic. Goldman Sachs raised its hand and said Brent crude might break the historical high of $147 from 2008. Saudi officials calmly replied that if the supply disruption lasts until late April, oil prices could soar to over $180 a barrel. Goldman Sachs added that this might not be a short-term phenomenon. Large-scale supply shocks usually last for years. Saudi Arabia continued to double down, saying they expect shortages to be even more severe next week, and prices might approach $140. Analysts say reaching $150 within a month is not impossible, and if we are talking about June, it could even go up to $180. Bond market traders have raised the probability of the Federal Reserve raising interest rates this year to 50%. However, before the conflict in late February, the market was still expecting 2 rate cuts this year. The European Central Bank has made a sharp turn from a dovish stance to a hawkish one. Today, European officials have hinted that if the data gets worse, they might discuss a rate hike as early as April. Imagine this scenario. The European economy is already dying from the torture of high energy prices, but the central bank might have to raise rates to fight inflation. The result is a collective dive in the global bond market. The US 10-year Treasury yield is close to 4.4%. The UK 10-year Treasury yield hit 5% for the first time since 2008, and the German 10-year Treasury yield hit a new high since 2011. The signal from the bond market is very clear. This risk is changing from a tail risk to a base case scenario. So, what is stagflation? It is when economic growth stalls while inflation runs high. This is the worst nightmare for central bank governors, because traditional monetary policy tools become almost completely useless in this scenario, because raising rates will kill the economy and cutting rates will make inflation worse. Now we come to the question everyone cares about the most. How high does the oil price need to go, and for how long to trigger an economic recession? The price threshold is an average of $138 a barrel, and the duration is an average of 14 weeks. Economists point out that the key lies in the suddenness and duration of the oil price shock. After oil prices soared to $147 in 2008 and then crashed, part of the reason was that the shock came fast and left fast. But the difference this time is, first, structural damage. The closure of the Strait of Hormuz and the destruction of infrastructure could lead to a permanent loss of production capacity. Second, the policy space is exhausted. Various countries have already used up a lot of their petroleum reserves, and their ability to handle the next shock has dropped. Also, there is the rigidity and elasticity of demand. In the short term, consumers cannot quickly change their consumption habits. In the long run, high oil prices will trigger demand destruction and economic structural transformation. Overall, we can understand that red line like this. The short-term red line is Brent crude staying firmly at $150 while the Fed is forced to raise interest rates. The long-term red line is that global strategic petroleum reserves drop to a dangerously low point, and there are no signs of geopolitical risks easing. Besides crude oil, we also need to pay attention to the US dollar. Oil is easy to understand, but the US dollar index has broken the 100 mark. This is a comprehensive indicator measuring the strength of the dollar against a basket of major currencies. Why is the dollar suddenly so strong? There are three reasons. First, the inflow of safe haven funds. The messier the world gets, the more money runs to the United States. This is an iron law since the financial crisis, and the US dollar is still the world's primary reserve currency and safe haven asset. Second, it is a relative winner in a miserable competition. Although the US economy is also hit by high oil prices, economies with higher reliance on energy imports, like Europe and Japan, are doing much worse. Not to mention, the US is a crude oil exporting country. Third is the forced hawkishness of the Fed. The market is starting to expect that the Fed might have to raise rates to fight inflation, and these rate hike expectations are pushing the dollar stronger. For the United States, a stronger dollar itself is not a bad thing. But in the current environment, it forms a double negative combo punch. Oil breaking 100 pushes up global inflation and eats away at corporate profits. The dollar breaking 100 worsens the tightening of global financial conditions, putting massive debt pressure on emerging markets. It is like being hit by a left hook and a right hook at the same time. It would be weird if the market didn't faint. Let's get back to the broader stock market. On the technical side, a record-breaking $5.7 trillion pushed into U.S. stocks today due to triple witching. This includes $4.1 trillion in index contracts, $772 billion in ETF contracts, and $875 billion in single stock options. What's more, cross-asset correlation and volatility are shifting at an extremely fast pace. Key technical levels are facing pressure, dropping below the 200-day moving average for the first time since May 2025. This technical level is usually seen as an important reference for judging long-term market trends. Once it is lost, it is often read as a potential bearish signal. Market risk analysts point out that although the current index has only pulled back about 5% from its historical high, the internal structure of the market has clearly worsened. Data shows that among the S&P component stocks, over 80% of stocks in the communication services, consumer discretionary, and technology sectors are already in a downward trend. In the financial sector, about 76% of stocks are also performing weakly. In addition, the advanced decline ratio of individual stocks is also clearly leaning towards the downside, showing that market breadth is shrinking. Currently, institutional investors are widely watching the key support level of 6,500 points. If it effectively breaks below this, it could trigger a larger scale of panic selling. However, some analysts believe that current market trading relies more on changes in macroeconomic variables, or in other words, changes in oil prices. All earnings data and technical levels have become invalid. The U.S. stock market is right at the tipping point where a crash and a short squeeze exist together. The fear index has reached extreme fear, hitting 26. This means many people are bearish right now. Since many people are bearish, it shows the market has already entered a state of panic. Market participation has also dropped to a very low level. Just like Warren Buffett said, "Be greedy when others are fearful." At this time, we don't need to panic, but that doesn't mean jumping in blindly. In the middle of this adjustment process, it doesn't mean you have to enter the market right away. Instead, you need to lift your head and keep your eyes wide open to observe. Just like I said before, institutional short positions are very crowded, so a short squeeze is not impossible. So the best thing to do right now is to wait. A short squeeze does not equal a reversal. A true reversal still depends on the conditions I mentioned before. First, the US-Iran conflict completely comes to an end. Second, the dispute between the Fed chairman and Trump comes to an end, and the new chairman successfully takes office. Alright, that is all for today's video. When the sun rises as usual tomorrow, we will find that oil is still there, Trump is still tweeting, and the market is still swinging between fear and greed. The only certain thing is that many fund managers and retail investors will spend a long, sleepless night tonight. This is Lineup Stock. See you next time.